We're from ECON-100 Group 24, and we're going to present our digital artifact and explain how government and monetary authorities can promote economic growth using fiscal and monetary policy. So before we delve in deeper, we're going to go over the general background. So both monetary and fiscal policy are macroeconomic tools that is used to manage or stimulate the economy. Monetary policy is primarily concerned with the management of interest rates and the total supply of money, and is generally carried out by central banks, such as the US Federal Reserve. Meanwhile, fiscal policy addresses taxation and government spending, and generally determined by the nation's government legislation. So now we can see how monetary policy and fiscal policy together, they have great influence over the nation's economy, its businesses, and its consumers. Next, we're going to go over the monetary policy.
So monetary policy is controlled by a central bank that is separate from a government. And the main primary goal of monetary policy is to control inflation, unemployment, interest rates, and the money supply in an economy. There are two basic types of monetary policy, which is expansionary policy, which is meant to grow the economy, while there's also contractionary policy, which is meant to slow down the economy. And some examples of monetary policy include open market operations, which is buying and selling government bonds or securities from banks, reserve requirements, which is a requirement of how much the bank has to keep in their reserve, discount rates, which is how much a central bank charges banks to borrow from it, and then inflation targeting, which is setting a target inflation rate so people know that how much prices are going to be rising, and that stimulates demand and expands the economy.
The aim of fiscal policy is to control a government's growth and prevent economic instability resulting in national economic consequences. Fiscal policy is determined primarily by a nation's legislative body rather than a national central bank. Fiscal policy targets government spending and income in the forms of taxation, social welfare programs, and investment spending, among other categories. And fiscal policy can vary annually and is often the result of policy initiatives. Thus, popularity amongst the electorate is often an important factor when considering new fiscal policies. Next, we'll talk about all of these things in the specific context of Sweden.
So this is Sweden's monetary policy, and the monetary policy of Sweden is decided by the Sveriges Riksbank, which is the central bank of Sweden. And the monetary policy determines the value of the Swedish currency according to the Sveriges Riksbank Act. The objective of monetary policy is to maintain price steadily, and the target of the Riksbank is to keep CPI inflation at about 2% a year. And at the same time, the monetary policy to approve an inflation target and should support the objective of overall economy policy to approve sustainable growth and a high level of employment. So the next one is fiscal.
Now, Sweden's fiscal policy framework first came about in the 1990s when Sweden underwent a financial crisis where their public debt nearly reached about 90% of their GDP. Next slide. So one key component in tackling this financial crisis was promoting a budget surplus, otherwise known as an expenditure limit or expenditure ceiling. Now, this is determined 3 years in advance, and they set a target surplus of 1%, meaning that in this 1% margin, they can operate, this surplus can fluctuate between this margin, and they can use expansionary or contractionary policy in order to counteract rather a reduction or a rise in the surplus.
And so when kind of bringing all that together and looking at Sweden's use of fiscal and monetary policy together, we can look at the 2008 and 2009 Great Recession and Sweden's response to it. As you can see in this graph with the real GDP, Sweden really made a quick recovery based on its practices, and that recovery was quick compared to other developed nations. So looking at their fiscal policy, first, their automatic fiscal policy was very important because it gave the unemployed and the people who were struggling because of the economic crisis a lot of resources to work with, and that social safety net really helped them out. And as Nathaniel said, Sweden had committed themselves to a surplus since the 1990s, which gave them a lot of flexibility in their spending and could really not worry about running up a deficit when spending to fix the economy. As their monetary policy goes, they had very aggressive monetary policy, and they lowered interest rates a lot, which gave families and households more disposable income, and they were able to spend and get themselves out of the crisis. Not using the euro as well is super important because it gives Sweden flexibility in their own economy and flexibility with their own currency.